Hello everyone, welcome to another episode of the Expert Launch podcast from India Ratings and Research. I am Rahul Kamdar, Senior Analyst from Core Analytical Group. Today, we are diving into the hospital sector with insights from Ruchika Agarwal, Senior Analyst from Corporate Ratings. So Ruchika, let's start with the demand drivers for the hospital sector. What factors are contributing to its long-term growth?
Okay. So in the corporate hospital sector is on a growth trajectory driven by improved access to care, an aging population, broader health insurance coverage, and medical tourism. Additionally, advancements in medical technology like minimally invasive procedures are improving patient outcomes, and that has been fueling the demand for hospital services.
That's great. So that was on the demand side. What about the supply side? Are hospitals well placed to meet this demand?
So on the supply side, corporate hospitals are stepping up to meet rising demand by investing heavily in the capacity expansion. In fact, capital expenditure in FY25, if we see, was more than double than that of FY23, and this strong momentum in bed additions is expected to continue over the next couple of years.
And that is significant expansion. Is this planned capex likely to be funded by debt? And in that case, how does India Ratings expect it to impact leverage in the sector?
Yes, part of the planned capex is expected to be debt funded, which could lead to an upstick in leverage across the rated hospital portfolio. However, even with this increase, the net leverage is likely to stay below 2.5 times in the near term, assuming there are no major acquisitions.
Below 2.5x, despite such aggressive expansion, how do you think this would be achieved?
So the aggressive expansions are expected by the hospitals are expected to maintain comfortable leverage levels. This is largely due to the better capacity utilization, stronger EBITDA, and robust cash flow generation. In FY25, the sector saw a shift towards higher value clinical and surgical services, with EBITDA growth outpacing revenue growth. This has helped the hospitals keep leverage ratios healthy even as investments ramped up.
That sounds good. How are hospitals expected to perform from revenue and profitability point of view?
So looking ahead, hospitals are expected to deliver healthy performance on both revenue and EBITDA. India Ratings anticipates double-digit revenue growth and healthy EBITDA margins across its portfolio companies during FY26 and FY27. We have seen decline in the return ratios. However, we expect them to gradually recover with improvement in utilization rates and increased patient volumes.
Got it. Before we wrap up, can you tell us what is India Ratings' view on credit metrics in this sector?
Sure. India Ratings expects credit metrics in the hospital sector to remain stable despite a sharp rise in capex intensity. Strong cash flow to capex ratios indicate that the companies are well positioned to fund their expansion. While interest coverage and leverage have moderated slightly, improved EBITDA supported by operating leverage benefits and better cash generation are expected to support credit metrics in the sector. This is reflected in 58% of the rated entities being on stable outlook, while 42% are on a positive outlook.
Thanks to our listeners for tuning in. For further insights on the points discussed in our podcast, you can view our research published on indiaratings.co.in under the Research and Publications tab, or you may also reach out to us in case of any queries. Thank you.